The live intraday price for Nokia stock on the New York Stock Exchange is currently trading at $13.52 per share, marking a visible decline of 2.45% during today's active session on June 10, 2026. This downward movement is accompanied by an elevated trading volume of over 54 million shares, a sharp surge that highlights intense institutional positioning and reactive trading. While retail traders using popular self-investing options like the Robinhood app or Interactive Brokers platform might look at this sudden dip as a straightforward market correction, the reality underneath the tape reveals an entirely different conflict. The immediate catalyst behind today's selling pressure is a wave of market chatter indicating that NVIDIA stock, the ultimate heavyweight of infrastructure processing, is actively laying the groundwork to design next-generation 6G mobile network hardware. This development has sent a shockwave through traditional telecommunications equipment providers. The sudden threat of a dominant silicon giant entering the mobile networking field has caused investors across retail and institutional circles to rapidly reevaluate their long-term growth assumptions for legacy providers. This specific tension is playing out across the entire market, influencing how capital flows between aggressive tech positions and defensive infrastructure allocations. The standard expectation surrounding Nokia stock for the past year was built on a story of a complete corporate renaissance. Retail investors using basic investing sites and automated tools like Schwab Intelligent Portfolios had grown accustomed to viewing the Finnish enterprise as a surprise beneficiary of massive cloud data center expansions. When the company reported its first quarter earnings in late April, the headline numbers seemed to validate that exact thesis, showing a 49% surge in net sales from cloud and artificial intelligence infrastructure, alongside a massive €1 billion in new orders. The general market narrative assumed that because the company was rapidly absorbing its Infinera acquisition and raising its network infrastructure growth guidance to 12% or 14% for the full year, it had permanently escaped its past identity as a slow-growth telecom equipment dinosaur. Online investing forums were filled with optimism, framing the company as an affordable backdoor play into the modern data center hardware boom. However, the reality hitting the tape today forces a much more critical assessment. The sudden drop in Nokia stock, down from its recent June peak of $17.45, proves that the market is still deeply uncomfortable with how dependent these legacy infrastructure players are on the shifting strategic whims of the primary chip designers. When a company like NVIDIA drops hints about designing specialized hardware for upcoming mobile network technologies, it directly threatens the pricing power and market share of the businesses that actually assemble and maintain those physical networks. Suddenly, the massive order books and the optimization of optical networks do not look quite as bulletproof. If you look at how investors execute trades on advanced systems like the Interactive Brokers trading platform, or look at active fund distributions on the Fidelity trading platform, the shifting sentiment becomes clear. The market is aggressively questioning whether legacy telecom networks can protect their market share when high-performance computing companies decide to optimize the underlying communication protocols themselves. To fully understand why this intraday price action matters, we need to trace the trading volume and structural momentum over the last few weeks. Up until this week, institutional activity in Nokia stock had been heavily leaning towards accumulation. Heavyweights like FMR LLC added over 57 million shares to their portfolios during the early part of the year, signaling that major wealth managers utilizing Fidelity investments and structured Fidelity mutual funds were eager to capture the expanding gross margins of the business, which recently climbed 320 basis points to 45.5%. At the same time, individual brokers users on platforms like SoFi Invest were capitalizing on the stock's low absolute dollar price to build long positions through Robinhood fractional shares. Options activity was surging, with traders purchasing calls and selling puts, looking to capture near-term volatility. But when macroeconomic pressures and sector-specific threats collide, institutional behavior can pivot instantly. The broader European tech sector dipped 1% today, and when global asset managers decide to trim exposure to infrastructure risk, high-volume liquid assets are the first things they sell to protect their broader portfolios. Comment below how many shares of Nokia stock you currently hold, or if you're completely avoiding this specific infrastructure sector right now. Looking past the immediate intraday noise, evaluating what this company actually does and how its modern business model operates is essential to separating short-term panic from long-term structural value. Nokia operates as a global provider of network infrastructure, mobile network equipment, and cloud software solutions. The business is fundamentally divided into distinct operational segments: network infrastructure, which encompasses optical networks, IP routing, and fixed networks; mobile networks, which covers the physical macro cells and radio access networks; and a highly profitable cloud and network services division alongside its technology licensing arm. The underlying engine of their recent financial turnaround has been the network infrastructure division, particularly the optical network segment, which grew 20% year over year following the integration of Infinera. This hardware is what allows modern
modern data centers to transmit massive amounts of data across fiber optic lines at lightning speeds, which is exactly why hyperscalers had been buying their products in record numbers. If we look back at the older reports and past performance metrics, the company has spent years recovering from the brutal restructuring eras that followed its exit from the mobile handset business more than a decade ago. For years, the stock remained stuck in a frustrating single-digit range, frequently criticized by analysts on top investing sites for its low operating margins and its inability to compete effectively against rivals on pricing. The business model was historically bound to the cyclical capital expenditure budgets of major telecom carriers, which meant that if telecom providers slowed down their 5G rollouts, revenues would crater. To break out of this loop, the current management team pivoted towards enterprise customers, defense applications, and direct cloud providers. This structural shift is what allowed them to report a solid €629 million in free cash flow and build a net cash cushion of €3.8 billion by the spring of this year, giving them the defensive balance sheet required to weather sudden industry downturns. This historical context is exactly where the tension between investor expectations and modern market reality becomes highly visible. The expectation was that by moving away from carrier-dependent revenue and towards cloud data centers, the company would achieve a permanent valuation multiple expansion, making it look more like a high-growth tech stock and less like a utility provider. The reality, as demonstrated by today's downward price action, is that the company cannot easily wash away its structural vulnerability to technology transitions. When tech giants begin discussing advanced mobile network integrations, the threat to legacy hardware margins returns to the forefront. Investors evaluating their options across Fidelity wealth management accounts or balancing risk profiles through a SoFi robo-advisor are forced to acknowledge that hardware manufacturing remains a capital-intensive business with low long-term structural moat characteristics, regardless of how impressive an individual quarter's order book might look. As we look toward the future outlook for the remainder of the year and into the late part of the decade, the trajectory of Nokia stock will be decided by a few critical catalysts and risks. The primary upside opportunity rests on whether the company can successfully defend its current market share in optical networks while rolling out high-margin software upgrades, such as their recently announced Deep Field Genome Shield product designed to protect large-scale networks from massive data overloads and cyber threats. If the business can prove that its software and security layers are indispensable to cloud builders, it can sustain its full-year comparable operating profit target of €2 to €2.5 billion. Furthermore, if the broader enterprise market continues to scale up infrastructure spending to meet processing demands, the sheer volume of physical hardware required could provide a rising tide that lifts all existing players, regardless of potential future competition from chip designers. Conversely, the downside risks are substantial and cannot be ignored by anyone engaged in online investing or managing an individual brokerage account. If tech giants successfully develop proprietary software-defined networking protocols that minimize the need for specialized external optical hardware, or if major chip makers alter the technical framework of upcoming mobile networks, legacy infrastructure providers could find themselves facing severe margin compression. Additionally, global macroeconomic factors like sustained interest rate pressures, corporate capital expenditure containment, and broader geopolitical tensions could prompt enterprise clients to slow down their hardware procurement cycles. If those cloud orders begin to cool off from their current 49% growth rate, the stock could easily find itself giving back more of its hard-earned gains, testing the patience of retail investors holding shares across various Robinhood investments or specialized Fidelity Iris. Ultimately, today's market activity perfectly captures the ongoing struggle between narrative and structural execution. The expectation told investors that this legacy firm had successfully anchored itself to the unstoppable momentum of modern infrastructure expansion, insulating its business model from traditional telecom stagnation. The reality, presented by today's price action, shows that the company is still bound to the broader volatility of tech ecosystems, where sudden strategic shifts by major chip developers can wipe out billions in market value in a single session. For long-term investors tracking positions through a Fidelity mobile app or executing complex trades on an interactive broker's account, navigating this landscape requires looking past short-term quarterly spikes and deeply analyzing who will ultimately control the margins of future network architecture. The business has built a resilient balance sheet and shown clear operational improvements, but it remains locked in an intense high-stakes race where the rules of infrastructure development are constantly being rewritten by the very companies that feed it data.